Thanks everyone for joining us here today at our housing panel. We've got a great panel of experts on the Canadian housing economy, and I'm going to start by introducing Bob Dugan, who's a chief economist at Canada Mortgage and Housing Corporation. He's to my direct left and your right. And there we have Tamara Lawson, who's a CFO at QuadReal, the real estate property arm of British Columbia Investment Management Corp. And then finally, we have Michael Bourque, who is the CEO of Canadian Real Estate Association. So thanks for joining me here today.
My pleasure.
Thank you.
So to kick things off, I mean, everyone always wants to know what the state of the Canadian housing economy is at. We've had a very long run over the past decade, extreme home price appreciation, especially in Toronto and Vancouver. In Vancouver, we've had price growth almost double over the past decade, outpacing gains in both New York and London. But everyone kind of wants to know how much more room do we have to run, especially with an economy that's slowing. So Bob, let's start with you. You're an expert, obviously, at CMHC. You guys cover everything from providing mortgage loan insurance to housing financing, and you've got a pulse on all aspects of the Canadian housing market. What's your outlook for where we are today, and are we at risk of a potential crash down the line?
So, to start with the outlook, we do expect to see continued slowing down in home prices, home price growth. We see less real existing home sales and starts in the near future. So we do have a slowing economy in Canada, the potential for some increases in interest rates eventually. And, there's been some policy changes that have had an impact on the market as well. So we do expect a little bit of slowing, but some of this slowing and the policy impacts have already been affecting the market. And we've seen places like Vancouver where price growth has corrected quite a bit. Toronto has seen a correction, now some stabilization, even a bit of an uptick in house prices. But what we have seen is these two markets of Toronto and Vancouver, where some of the biggest imbalances have been, and where you mentioned some of the biggest price growth has been, we've seen recently much convergence between the fundamentals supporting the housing market and house prices. So we see much less overvaluation, for example, in these markets that we've seen in the past. And so it seems like the imbalances are unwinding gradually, and the market is getting more healthy from that perspective in terms of how prices line up with fundamentals.
Thanks. Michael, you oversee a real estate association of 130,000 realtors, agents, salespeople across the country. So what's your perspective on where we are at the market today with the unwinding that we've seen in Toronto and Vancouver after the regulations came in place over the past year and a bit? Are you seeing that we're kind of bottoming out, especially in Vancouver, and that we're coming back up a little bit in both markets, or?
Yeah, it's tempting from the viewpoint of London to look at Canada as one market, but in fact, it's many markets. Housing markets are very local, and so if you look at Vancouver, for example, it more than other markets in Canada has been affected by a variety of demand suppression policies. First of all, you have very stringent mortgage underwriting policies, including a stress test that requires a new home buyer to qualify for an additional 2 points, 200 basis points above the Bank of Canada rate. And then you have foreign buyer taxes, you have vacancy taxes. So these things have put the brakes on demand quite a bit. And that is why you've seen prices go a little bit down in Vancouver, but not that much. But sales have certainly really slowed down in that market. Whereas if you take a market like Montreal, been very, very strong market in Montreal, almost double-digit growth in the market there. Very strong pricing, strong sales, starting to creep into supply problems. And then Toronto in the middle, more recently, in the last month or so, we've seen a lot of growth, retake up, because there was, again, after the B20, which is the series of underwriting rules, came into effect, and especially the stress test just over a year ago, Toronto was very much affected, but sales have come back. But what's happened is it really affects first-time home buyers, and especially lower prices. So you've got a combination of people buying further away, so it's sort of intensifying the urban sprawl, if you will, because people sort of drive until they can afford it. And it's really driven up the prices of entry-level properties. So, when you add it all up in Canada, we have a number of markets, and we definitely have some fundamental supply and demand problems.
Tamara, you're the CFO of a real estate arm in Canada. You've got 2/3 of your property portfolio in Canada that's worth almost $30 billion. So obviously you have a lot at stake here with the housing market. What's your outlook? From the perspective of QuadReal, what's your outlook on where the Canadian housing market is headed?
Well, we're, I guess, very bullish on the Canadian markets that we talked about already, Vancouver, Toronto, Montreal. Those are, we call them the MTV markets. They're the strongest markets in Canada right now. We do take a longer term view, given our capital is very long term. So we're very committed to markets where we're seeing very sound fundamentals in the long term. As we talked about, there is a bit of a correction that's been going on, particularly in Vancouver, but long term we still see those markets as being very strong. We see significant population growth in those markets, particularly in the GTA. There's structural issues in Toronto with the greenbelt that surrounds the city of Toronto, so there's limitations in terms of the supply. So I think long term, we feel very positive about those markets. We're focused on both building condos, densification in retail-oriented markets where there's strong transit connections, so that's one of our focuses. But also, we're focused on the rental market as well. So we believe those markets continue to be very strong in all three of those markets. In Vancouver, the housing market has come off, but the rental market still performs extremely well. We're still seeing good rental growth in all those markets. Supply is very constrained as well. So, we think that from an investment perspective, in terms of multifamily, all three of those markets are strong, and we feel that they're good markets to be invested in.
Bob, I just want to bring it back to you and kind of break down the Toronto and Vancouver housing market a little bit more. Now in Toronto, we've seen an uptick in sales and we've seen prices continue to rise steadily over the past few months. But in Vancouver, the market has been hit really hard over the past few months. And the question that everyone has on their mind is how much longer will this continue for, and are we going to see a bottom to come for the next few months, or have we already reached that? And so what is your viewpoint on that market?
Yeah, so I think, when we look at it forecasting, we could expect a little more correction in Vancouver, but I think the points you made are very right, in that the fundamentals in Vancouver are very strong. It's a very rapidly growing economy, but it's also a very supply-constrained housing market. And so Toronto and Vancouver, the supply constraints are one of the key factors that we found led to this price escalation that we've seen in recent years. And so, there's a temporary pause in Vancouver, but I think as that demand strengthens again, people get back into the market, one of the risks is those supply constraints can become binding again, and we could see price growth again. And so one of the keys that we think to these markets is really dealing with the supply inelasticities, so that lack of responsiveness of supply, because even if prices are more in line with fundamentals right now, prices are very high relative to incomes, and so affordability can be an issue for many buyers in those markets.
And Michael, what's your viewpoint on sort of the room for, or the outlook for potential price appreciation or depreciation in those two markets, given that you've got a strong pulse on it?
Yeah, well, our forecast generally is positive, about in line with the Canadian economy for this year. In those two big markets in particular, I think we've had, again, a number of demand suppression policies, and at the same time, sort of endemic supply constraints. And really what it points to is the need for greater policy innovation to help new supply come on stream. We're starting to see that. The province of Ontario recently announced some really excellent policy innovations that will encourage new construction. And in British Columbia, there's still a big focus on demand suppression, so I don't know what's going to help supply there in the short term. But I would argue that from an investment standpoint, this slight pause in growth and reduction in prices means that it's a really excellent opportunity, because the fact is that there is tremendous demand, both domestically and globally, for housing in the Vancouver area. So these are temporary problems. I would also add that policy innovation can't exist on its own. It also needs private sector innovation in terms of new housing stock, entry-level housing, but obviously you can't construct until you have a permit, and that means you have to work with governments, and you need to advocate with governments to ease up some of those constraints to new supply.
One thing I would just add to that conversation as well, from a risk-adjusted return perspective, the markets we've been talking about, primarily Vancouver and Toronto, have performed extremely well when you compare with them to other markets, both in the U.S. and globally. So the volatility of those returns have been very low and been positive over the last 10 years with very little standard deviation to them. So it's one of the things about the Canadian market that is a bit different than the U.S. and other global markets as well.
We've seen both of those cities, Toronto and Vancouver, a little bit Montreal, especially transition more and more towards, international cities and becoming more like renter societies, even though for a long time it's all been about home ownership. Obviously now we have an increasing affordability issue in both those cities, given the supply constraints and the increase in population. So what does that mean for you, Tamara, in terms of investment opportunities, in terms of what areas you see growth, given those fundamentals?
Well, yes. So, one of the things that's interesting from our perspective is if we look at Toronto and you look at where a lot of the population growth is, it's right outside of the city of Toronto, so in what we call the GTA, the Greater Toronto Area. So in some of the cities that are just connected to Toronto, but just outside Toronto, we're seeing very strong population growth, limited supply of multifamily units in those markets, and a lot of demand, and a little bit more affordable than in Toronto. So we're seeing really good investment opportunities in some of the markets around Toronto. Land prices are cheaper, so the cost, to develop is less so, and we see that as a big opportunity. The other opportunity that we're seeing is densification of some of the retail malls that are located in Toronto. Historically, we haven't seen a lot of condo development connected to those retail locations, but there's a real demand because they're connected to transit. Transit is a big issue, for every global city, but especially for Toronto. We're a bit behind in terms of our supply of transit to the city. And so, we're very focused on well-located retail locations where we can add densification. We can develop cost-effectively. We own the land, and we basically partner with typically a developer or an owner of a retail location, and we've been building condos, and we see that as a great opportunity going forward as well.
Natalie, I'll jump in here and just point out that this is a really great example where policy innovation can take place. So in Canada, we're building a lot of transit systems in Toronto in particular, and the national government is spending billions of dollars subsidizing these big infrastructure projects, and yet they don't have conditions attached to those to that spending that relate to densification and building of affordable homes or rental properties for that matter. There's a section of the subway being built in Toronto that goes 8 kilometers without a station. If you add a station in halfway and allow for building and densification, then you're going to see that kind of supply response that we need. So, this is the sort of thing we're advocating for on behalf of homeowners, is to see the federal government step in and say, okay, well, we're willing to spend this money, but there's conditions that come with it.
Bob?
Yeah, I was just going to say, I think this densification argument is very, very good. In places like Toronto and Vancouver, about 80% of the price of the home is the land that the home sits on. And those prices have been going up. And so if you want to get better affordability, you do have to get more families on that, a given size piece of land. So that's all about densification. And densification also, so there has been some condo construction in these cities, so some densification increase, but we're not always building the right kind of condos. And so there's a lot of bachelor units being built, and so there's not a lot of supply of 2 and 3 bedroom condo apartments that'll allow families to make that switch from single family homes further out in the suburbs to something that's affordable downtown. So we need to also think about what kind of homes we're building or condos that we're building in order to promote that densification and make it a viable option for Canadian families that live in these centers.
Building off of that, we've seen a lot of condo investors come into the market and help provide that demand that's led to an immense growth in condos being constructed across these two cities. At the same time, we've seen condo price growth slow down a little bit, but we haven't seen that yet for rent growth, although some are saying that perhaps when all this new supply comes in, et cetera, rent growth could slow potentially or whatnot. So Bob, from your perspective, I mean, you guys are, helping out with this homeownership issue by providing a first-time home buyers incentive with the federal government, where you guys are going to take an equity stake in new homes for first-time buyers. What's your perspective on how that's going to impact the rentership market across Canada?
Well, a very interesting question, and I think when you promote home ownership too much, what can happen is that can bid up house prices, and particularly in supply-constrained markets. And to the extent that that might price some people out of the market and they stay in the rental market, that leads to upward pressure on rents. And so, these programs have to be accompanied by supply initiatives to help supply the market. And so, now the first-time home buyer initiatives are there really to help at the margin with new home buyers or first-time home buyers. We estimate that they'll have an impact of about 0.02 to 0.04% on house prices in Toronto and Vancouver. So not a very big impact, but they will help people on the margin. But I think the focus really has to be on supply and getting more units built for people to sort of help offset the price pressures that come from strong economies and markets with limited supply. And
just to build off of that, you've also estimated that around 100,000 families might take up that new incentive. Yeah. So that's obviously going to have an unloading in terms of pressure on the rental market across the country. Yeah. What's your viewpoint? Well,
rental markets, the vacancy rates in Toronto and Vancouver are down around 1%. So there's very little supply there for people. So it's very important to build rental as well, and most rental new rental supply does come from the condo market. So investors who will buy a unit and then rent them out, and in Toronto that's about 34-35% of the stock of condominiums. It's a bit lower in Vancouver at around 26-27%, but that's a very important source of growth and supply. But that tends to be supply at the higher end of the market. We still need to see, as I was mentioning earlier, more initiatives to help get some new units built at more modest price levels so that renters with more modest incomes can afford those units.
Tamara, given all of these trends and what CMHC is doing to incentivize developers to provide more rental housing and more apartments, how does QuadReal feel in terms of the environment for building and developing more of these properties? Obviously, we've seen a lot of competitors come into the market over the past 2 to 3 years to jump in on this opportunity of surging rent growth. In your viewpoint at the same time, we've seen interest rates go up a little bit, and we're seeing construction financing becoming more expensive, and construction in general really becoming more expensive. So what does that mean for you as an investor in these types of properties?
Well, for us, we have many sources of capital. So we have, from an equity perspective, BCI, who's both, growing their fund, and their clients are increasing their allocation to real estate. So, we're seeing, our funds are growing basically in terms of what we need to deploy. And then on the debt side, we're seeing, a lot of sources of capital. We do utilize CMHC financing on the multifamily side, which is, a good program that we have, very similar to Fannie Mae and Freddie in the U.S. and other programs that you might see globally. But, that's very, very good financing for building multifamily product. And, we have a credit rating in Canada, so we can issue bonds. So we have a lot of available capital, and we have a number of partners that very strong, well-capitalized development partners that we're working with. So for us, it's about really focusing on the areas that we think are going to be the best opportunities and present the best returns long term for us, and then partnering with very, very good, well-capitalized partners. I think we're looking at investing in sectors that will perform well in all economic cycles. So I think there's always concern that there's too much condo building going on in Toronto and Vancouver, and I think some of the potential developments we see may not get built in Toronto. So one of our focuses is just partnering with the right people, and we think picking the right markets, and that's really our investment strategy.
Perfect. And you also have a really big lending portfolio as well that's dedicated towards providing construction financing for multifamily development as well. And when we spoke last time, you mentioned that you've seen growth in that business. Just touch quickly upon what kind of growth you've seen and what opportunities are there.
Well, yeah, so we also now, as in addition to the real estate side of things, we also have a mortgage business that we're overseeing. So we will provide construction financing to strong developers, and we're seeing increased demand across the country. We're also growing that portfolio outside of Canada as well. But we are seeing a lot of construction financing, and I think that's obviously going to help with supply, because there is pretty good sources of financing within the Canadian market.
So again, you've got strong sources of capital, and the policy innovation there that would really help in that instance is in Ontario, where the construction company doesn't need to pay for the development charges for 5 years on a multi-residential property. So that's going to provide an incentive for people to get into that market and help with supply. But I guess the other thing that's happening is we're in a pre-election period in Canada. And so parties are vying now for position, and we've seen a number of new policy statements coming from the different political parties in support of home ownership. And one of the reasons that it's a very strong issue in this election is that the largest voting bloc for this election in Canada will be millennials for the first time. And when you survey millennials on their top issues, affordable housing is at the top of the list. It's also at the top of the list of new Canadians. So building on the comment from a previous speaker, we are seeing very strong immigration levels in Canada. One of the reasons people move to Canada is because they believe that they can achieve their dream of home ownership, and it's an expectation that they have. So this is putting a lot of pressure, and new Canadians are in fact the largest group of first-time home buyers. So it's putting a lot of pressure on the government and on political parties to come up with different ideas and policies that will help to incent new supply. Because I think it's very clear we've had quite a few demand suppression policies, but not so many on the supply side. And so if I'm looking at it from your standpoint, what about investing in Canada? You heard earlier about strong fundamentals economically in Canada, including population growth and highly educated workforce, very low unemployment, and there is a huge opportunity in my view to build in Canada. We still have average household home prices of less than $500,000 Canadian dollars, so I don't know what that's in pounds, quite a bit less. So we tend to talk about this high indebtedness, but it's not as big an issue as maybe is seen by some, because people have very low default rates, and in Canadian culture, we like to own homes, and we'll do everything to make sure we pay our mortgage above anything else, pretty much. So it's a very safe investment.
And one thing, just to add to that, although prices have gone up a lot in Canada over the last, call it 10 years. When you compare Toronto and Vancouver, but especially Toronto, to other global cities, it's still, quite affordable. So, I mean, in terms of people, some people think, since it's gone up, the market's gone up so much, there's no room to go further. But when you look at it from that context, and the limitation on the supply, we still think, the fundamentals are very good.
Bob, we've got around 4.5 minutes left, so I kind of want to direct this question at you with regards to the potential risks that remain in the housing economy. CMHC has spoken quite a bit for the stress tests that were put in place with regards to the market to tame the housing prices. And even though you've had a lot of pushback from a lot of realtors, a lot of associations and developers saying that it's done its job, prices have slowed down, price increases have slowed down across both Toronto and Vancouver, CMHC maintains that it's still needed, the market is still at risk. So, from your perspective, what's the biggest risk for the Canadian housing market?
Sure. Well, the risks to the housing market really tie in a lot with household debt in Canada. And when you look at household debt, it is very high. And the risk there is that if there's some sort of a downturn, because I recognize what you're saying, that right now, when you look at default rates on mortgages or arrears rates, they are very low. And because of recourse on mortgages in Canada, you kind of have to pay it back. You can't just hand the bank the keys. But what happens if there's some sort of an economic downturn and unemployment rises? And increasing unemployment is really the biggest risk to housing and to household debt. Once unemployment rises, that's what correlates with increases in arrears. And when you have heavily indebted households, the pressure to service that high level of debt when your income source disappears can really exacerbate the economic downturn. So I don't know if there's a recession in Canada, because I heard in the earlier session they were talking about maybe trade wars affecting the U.S. economy and having an impact on Canada. Well, if we do have that recession for whatever reason, even from an external source like that, if our unemployment rate goes up dramatically and you have heavily indebted households, that's something that could really be a risk to us and make the downturn worse. And I think if you ask the Office of the Superintendent of Financial Institutions, the folks that are responsible for putting that stress test in place for Canada, that household debt was their key target when they were putting that in place. And so it's well known that Canadians have a high level of debt. They also have a high level of assets, to be fair, but those assets are really concentrated in real estate. They're not that well diversified. And so there is really this risk related to some sort of a recession scenario being made much worse by the leverage that exists in Canadian households.
Thank you. Bob, I also want to touch upon the various geographic opportunities across Canada. We touched slightly on Montreal as being another market for opportunities. Obviously, Calgary is a big one, and we've seen with the pipeline announcement by Trudeau that it's going through, that perhaps that could be something for the market to look at as well. So from your perspective, seeing the activity across Toronto, Vancouver, Montreal, Calgary, tell us a little bit about the opportunities across Montreal and Calgary and where you see the housing markets going from there, especially for investors when they're looking at extremely high home prices right now in Toronto and Vancouver. Perhaps they might want to look at those other two markets and see where it's at.
Well, certainly, when you think about Montreal, a lot of people focus on Vancouver and Toronto because they've been kind of the two centers that have got so much attention. But Montreal has one of the strongest local economies in Canada, and we've seen a lot of growth in that center and house prices. We've recently, sort of through our housing market assessment tool, have identified some overheating in that market, and we're really watching prices because it could be the situation very soon that we'll be starting to detect some overvaluation in that market. So we've certainly seen some trends and some growth in that market. So for sure an opportunity. The provinces out in the cities out in Alberta, like Edmonton and Calgary, have really sort of suffered in recent years because of lower oil prices. And it's a very resource-sensitive market. When oil prices are high, you see a lot of high-paying jobs attracting people from other parts of the country. You get these population growth booms in Calgary and Edmonton, and with strong wage gains, and you see a lot of price growth. That hasn't been the case in recent years. And so those markets actually have come off a period of high oil prices where there was a lot of construction in the market, and what happened was when oil prices dropped, the ability of the local economies to absorb those units under construction really deteriorated, and so we have a situation of oversupply in these markets. Now, the announcement of the pipeline being very recent, if that leads to higher oil prices, particularly a narrowing of the gap between what Canada sells its oils for compared to global prices, that could be helpful to those economies and could be an opportunity where we would see some more job creation and potentially some upward pressure on demand and home prices eventually.
Thank you. I think our time is up. Let's thank our wonderful panelists for being here with us today.